Modern tax regimes are built on the principle of progressivity. As wealth grows, the statutory tax rate increases. But when we look at the data for the highest percentiles of wealth, there is an observable gap between how the law is written and how it actually functions. We tend to measure economic inequality by looking at the surface, the visible flow of taxable income. But beneath that surface is a massive accumulation of capital that moves completely detached from those surface-level flows. To see this gap empirically, we can look at a specific dataset from India, sworn general election affidavits. By law, candidates must declare both their total accumulated wealth and the income they report to the state. Researchers cross-reference these localized disclosures with central tax data and the Forbes list of billionaires. This creates a rare, unbroken statistical window that reaches all the way to the top 0.1%.
Tax systems rely on the assumption that annual income is an accurate proxy for a household's total economic power. This dataset proves that this assumption fails to hold at the highest percentiles of wealth. We have to establish a macroeconomic benchmark. According to national income accounts, the average return on capital across all assets sits at roughly 7.2%. That is the baseline return we should expect to see in a transparent tax filing. This scatter plot maps the reported income to wealth ratio. For the bottom 10%, reported income is double their wealth. But as wealth increases, the proportion plunges. The wealthiest 0.1% declare incomes equal to less than 2% of their wealth. Narrowing the focus even further, the top 100 Forbes-listed families report an income-to-wealth ratio of less than 0.6%. Compare those numbers back to the 7.2% macroeconomic baseline. The ultra-wealthy are successfully hiding over 80% of their actual capital returns from the state. This data represents a departure from simple loophole seeking. For the ultra-wealthy, the statutory connection between capital accumulation and reported taxable income has essentially vanished. To address this systemic leakage, policymakers have to stop viewing evasion as a moral failing. It is a rational, calculable gamble. In public finance theory, this is formalized by the Allingham-Sandmo framework, which models the decision to report income as an expected utility maximization problem. The government sets 3 policy parameters: the tax rate, the penalty rate, and the probability of an audit. The taxpayer has a true income and must choose their reported income. The taxpayer maximizes their expected utility by weighing 2 possible states of the world: State X, where they hide money and go undetected, and State Z, where they are caught and forced to pay the penalty. By differentiating this equation, we get the first-order condition. This represents the precise mathematical equilibrium where the taxpayer finalizes their reporting decision. The economic intuition is straightforward. A taxpayer stops evading at the exact moment the marginal utility of hiding $1 extra equals the expected marginal pain of getting caught. Evasion is a mathematical equilibrium. Manipulating the inputs is the only mechanism the state has to change the taxpayer's output. Using this first-order condition, we can ask what happens to the rate of evasion when true wealth scales to extreme levels. We analyze this using Arrow-Pratt measures of risk aversion. For the ultra-wealthy, the critical assumption is decreasing relative risk aversion, or DRRA.
The behavioral mechanics of DRRA dictate that as a person's total wealth reaches into the billions, fixed financial penalties lose their significance. The individual becomes relatively less risk-averse to the threat of fines. When we apply decreasing relative risk aversion to the model, the result is clear. The proportion of evaded income mathematically increases as true wealth increases. If the system operated under constant absolute risk aversion, reported income would scale uniformly across all brackets, but that does not reflect the reality of elite financial behavior. Classic microeconomic theory predicts the empirical data we see in India. Massive capital accumulation neutralizes the psychological deterrence of standard financial penalties. Standard policy assumptions encounter a significant hurdle. They treat audit probability as a fixed exogenous variable applied equally to the entire tax base. But extreme wealth unlocks a distinct asset: concealment technology. This takes the form of offshore accounts, limited liability partnerships, and agricultural tax shields. We have to redefine the audit probability as an endogenous function. The probability of detection becomes the government's baseline audit intensity, multiplied by 1 minus the taxpayer's level of concealment. This creates a hard limit. As the taxpayer's concealment capability approaches 1, their effective audit probability approaches 0, regardless of how intensely the government audits the general public. The entire expected penalty side of the equation collapses. The structure is rendered impenetrable to standard enforcement tools. The ultra-wealthy do not fear the penalty rate because their capital purchases the concealment infrastructure required to zero out the probability of it ever being applied. We can now overlay this theoretical engine directly onto the empirical election and Forbes data. This chart shows exactly where these variables live. High concealment capability and decreasing relative risk aversion map onto the plunging right tail of the distribution. Conversely, working-class compliance is driven by high relative risk aversion and lack of access to concealment vehicles. The empirical fixed effects regression bears this out. When a taxpayer's perceived probability of detection goes up, for example, politicians forced to operate under heavy media scrutiny, their reported income ratios rise accordingly. The disparity between the tax code and these reporting trends is the predictable mathematical output of a system that ignores endogenous concealment and risk behavior. This matrix outlines the first required policy shift. Governments must move away from blanket, randomized audits in favor of discriminatory enforcement that specifically targets concealment vehicles and complex asset classes. Second, lawmakers must acknowledge the mathematical ceiling on statutory penalties. Raising the penalty rate yields 0 additional revenue if the taxpayer's concealment infrastructure has already driven the detection probability to near 0. Finally, this data necessitates a shift away from elasticity-based income taxation toward direct wealth taxation. Income flows at the highest percentiles are infinitely elastic to evasion. To capture economic power, enforcement must tax the underlying immovable stock of capital assets. You cannot tax what you cannot track, and you cannot deter a taxpayer who has successfully factored the penalty into their operational overhead. Tax evasion is a structural feature of the economic code. True progressivity is impossible until policy actively governs the mathematical mechanics of elite optimization.